Let's talk about smart money trading and the concepts behind the big movements that we see in the market. After watching this video, you should, one, be able to identify market structure, be able to know which way the market is moving. Also, you should be able to identify, locate areas where the market is breaking structure, either to the upside or to the downside, and then also be able to identify market reversals in the market. And then I'm going to go over a strategy showing you basically how smart money works. Okay, and all smart money trading is, or the concept behind it, is where the institutions and banks are moving aggressively from, say, certain swings or certain zones where the market is pushing with aggressive force to the upside. All right, where we have aggressive buying, and then the same thing in reverse if the market is moving lower to where we have aggressive selling with continuous breaker structures lower. I talk about this. I've kind of beat this concept up, or this idea up, in multiple videos here on the channel. But I know that everyone has a hard time reading structure of the market. I know people struggle with price action trading in a sense. Those two are two separate things, and you have to master both. And if you do not master both, then you're not going to succeed in this business. I'm going to put that out there and just disclose it straight up and down. I mean, there's no hiding it one way or the other. Lots of people think that just finding a strategy and being able to trade that specific or particular strategy is going to work all the time. No, it does not. Okay, strategies work, but there are principles, there's concepts, there's things that you must understand and grasp and educate yourself on that you incorporate with that strategy. The strategy alone is not going to work. You have to understand market structure. You have to understand price action. You have to understand overall what's going on within the market when it comes to what the banks and the institutions doing. Because as retail traders, I say this all the time, we do not make up not even 1% of the market. When I say this, what I mean is that we don't make up the movements of the market. We don't dictate how the market is moving. I don't care how much money you have. All right, understand that. So first, what I want to do is just show you just a prime example, okay, of what market structure looks like. Okay, and then we'll identify the reversal in the market and talk about that a little bit. And then we'll move on to the strategy following behind the smart money concepts and the way they actually trade. I'm going to show you an example. So please, I want to say this because people think that just because they have a solid strategy, or they start to want to learn someone else's strategy, or possibly even my strategy, that it's going to work 100% of the time. First and foremost, strategies do not and will not work 100%. There's nothing out there, there's no holy grail that's going to work 100% of the time. You have to understand first how a strategy works, but before that, you have to understand what is it the market is truly trying to do. And then you hear me also talk about reading price action when the market comes back to the zone. What does the structure and price action look like when the market gets back to the zone? You have to be able to read the market, not just wait for example, the market comes back to a demand zone, and you expect, because it's a high probability area to where there's a gap or imbalance resting back at the zone, that it's automatically going to reject and you get into the trade, right? Once you scale down and move down to your 12 range chart. That's not, yeah, it may reject some, but you have to understand what was resting right above as in regards to price action and the structure of the market when the market was coming back to that zone. What does price action look like coming back to that zone? Do I have an area? Is there enough opportunity for me to take a trade going back up? There could be a means or an area of resistance right above that may block that trade. And you say, well, what happened? What happened? You know, the market came back to a demand zone. The strategy, what you talk about is there. I waited for the rejection. I got into the trade, and then it went one opposite direction. One, we don't, again, dictate what happens in the market. Okay? Yeah, it may have been 100% set on, dead on the strategy. Everything unfolded just nicely. But guess what? The institutions, the banks decided to push the market lower. Look, strategies work, but they're not going to work 100% of the time. So understand that. So let's move on, okay? Because people always like to, for some reason, point fingers. Not just like, say for me, there are tons of traders out here that are experienced or professional level traders that are sharing valuable information with other people. And then people who are in general, who are not professional traders or do not know enough about the markets and what's truly going on and how to read the charts correctly, They expect because someone shows them something that it should work, and if not, they get the point of fingers. Guys, please stop doing that, because look, I'm telling you right now, strategies work, but they do not work 100% of the time. Nothing does. That's the reason why trading is all centered around the idea of probability. And if you do not know how to cut your losses and take them like a man or a woman, and then live to see another day, meaning cut your losses early enough to preserve capital to get back into the next trade setup, to make back what you lost and keep it moving to become profitable, then this isn't the business for you, simply put. Because in this business, it's not like going to work in a 9 to 5 and you're getting a automatic or consistent check that's the same each day or each week, okay? Not in this business, because we don't control it, all right? Now let's talk about smart money trading. First, market structure. The market, as you can see here, the last few days, I should say, into the beginning of February, what do we see here? The market ramping up, moving to the upside, okay? You should be able to see the breaker structures. Each time the market makes a new high and higher low, what are we doing? We're breaking structure back to the upside, or going to the upside, right? Now, at some point, at any point, the market can change direction, okay? We can get a reversal. As it does right here, it reaches the top here, say around 120. And then what does it do? It tops out, it topples, and then it starts to break structure below. Some people will call, when we get the first break, lower below a previous low, meaning we have, or the previous lower high, okay? I'm sorry, not the lower high, higher low. This is a higher low right here. This is a higher low right here. When the market moves and reverses and it makes its first break below the most recent higher low, okay? All right. When it does that, then that could be either a breaker structure. Some people call it a change of character, however you want to call it. But it's the first indication that the market is possibly wanting to move to the downside. And as we see here, we get that break below breaker structure, below this previous higher low right here, or the change of character, whatever you want to call it, and the market moves lower. We start to make a low, lower high. So then that's followed up when we have low, lower high, and lower lows. Making structural breaks to the downside. And what do you see? The market keeps doing that. Okay? Lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. All right? So as long as we're doing that, we're moving to the continuous downside, then we're breaking structure. That's all market structure is being able to follow what is the market doing. Is it pushing up? Is it moving down? Or is it moving down? Is it pushing up and breaking structure, or having a change of character? So this will be like here. The market pushes down into yesterday's trading session, and then I believe the market kept, well, yeah, we got another break of structure right here after a big retracement here, or pullback, another structural break below this area here at 585. But what I'm trying to show you is that when the market got down here, let's see what we have to the left-hand side of the chart. Yes, we have, if you look over here, we have, let's see, the market came down right here, squeezing this in right here. There's an area of support resting right here, and it bounces right there. Okay, support. The market can bounce at any area of support and resistance and then do what it wants to do. But what we have here is when it broke above this area of 648.5, that's a break of structure or a change of character. Change of character means that it's the first indication again that the market maybe wanted to move direction or shift direction back in its opposite direction. Meaning it was down here, now it's trying to push back up. Retrace some to break structure back down to the downside. Okay, same here. The market starts to push higher here, broke through this area here, gets up here, and then we get a collapse back down to the downside. What is it doing? Changing character again, or having a break of structure back down to the downside. Again, however you want to call it. But typically people like to, traders like to say change of character, specifically when there is a shift in the market, where the market breaks through a higher low, okay, or it takes out a lower high right here, in this case right here, what it did when it moved back to the upside. So we're getting structural breaks to the upside, shifting, reverse, move lower, and then the market pulls back and it breaks structure back down. Now, what I want to do is show you an example of, the strategy and how I trade. It's just quickly surrounding supply and demand. Okay, the idea of supply and demand is really following suit with what the market, what we see the banks and institutions doing. It's called smart money trading. Okay, the whole concept around that, because what we're doing is identifying aggressive areas of buying and selling. Just like right here, when the market broke structure, took out this area here below 18,016.5. What do you see here? Aggressive selling to the downside. That's the banks and institutions. Retail traders don't make those kind of moves. quick, swift, big moves to the downside like that, this would be an area of supply if we get back up here. It's already an area of supply because supply equals what? Aggressive selling. Again here, push down, pull back, break structure. What do we have here? Aggressive selling, okay, supply. Again here, push down, pull back, break structure. What do we have here? Supply, okay? Aggressive selling, pull back, aggressive selling, pull back, aggressive selling. All these are areas of supply that are created by the banks and the institutions. That's why they like to title it, quote unquote, smart money trading, okay, the concept behind it, all right? So I'm going to show you an example of a supply or demand setup, okay? The way I trade it, because I don't quote unquote call myself a smart money trader, but that's what it is when we're looking for movements to where the market has either made a thrust to the upside or push to the upside to where we have an area of demand, or a push to the downside to where we have a supply area. But we have to, I'm going to stress this, you have to be keen on following price action, trading price action when the market gets back to the zone. What does price action look like when you get back to the zone? Is there room to take a trade either long or short? That's the thing about trading, smart money coupled with price action. Now, another big part about smart money trading, the concept behind it, is that you hear me talk about imbalances. Imbalances are a critical piece of the puzzle when it comes to smart money trading, all right? Because typically speaking, if we have where the market pulls back to a demand zone, I'm going to show you here in a second, okay? And then there is an imbalance resting above, and when we get a rejection back at the zone, at a demand zone, that's a beautiful recipe to go long, back up to fill in at least the first area of imbalance. Now, the market can go up and fill as many areas of imbalances that it wants to, but you always understand that the market can reject at any area or whether there's a gap or imbalance there. Say it like that, okay? All right. So, example here I'm going to show you. Take a look. We see the market run to the downside. It pushes back up. So what does it do? It breaks structure. We get a change of character, okay? Pushes up. Above here at 645.5. Pulls back. We get a break of structure above here, correct? So we got the break above, change in direction or shift in the market. Right here, makes a high, higher low, followed by a higher high. What came out of this swing to the upside right here is what? Demand. Aggressive areas. Typically, I like to, when I speak on, say, a demand or supply area, I like to see at least 3 candles close to the upside with that. That tells me that there was enough push, which tells me there was enough demand. 1, 2, 3, aggressive buying to the upside. What I like to do then is draw off my demand zone. Okay, I draw my demand zone off, but I like to be able to see and identify, is there a gap or an imbalance resting back, or just say gap, a gap resting back at the zone from where the candle that closed below the last bearish candle to the downside and it closed, was there a gap from the candle that closed above it to the next candle that formed? Basically meaning it could be the third candle, it could be a second candle, just depends on price action. But this candle here that closed above this last bearish candle to the downside right here, and then the next candle that closed, from the bottom end of the wick of that candle to the top end of this last bearish candle to the downside, there is a gap. This is what helps me identify a high probability zone. And then I'm going to wait patiently for the market to pull back to it. In this case here, it pulls right back to it immediately. Meaning, when I say immediately, I mean we don't have this type of price action going on right here. Okay, to where the market is pushed up here. Excuse me. Let me do this right. When the market pushed up right here, okay, and pulled back, and then kept pushing to the upside, and then decided to pull back to this area right here, say for example, right here, okay? It didn't do that, all right? I know that's kind of wonky, but, I'm just kind of showing you an example real quick so I can move on. But the market does pull back to this area of this demand area right here. I don't take my trades off of my higher base chart. I'm only marking my zones off of a higher base chart, and then I switch over to my lower base chart looking for the trade setup. And I talk about the trade setup and the strategy across multiple videos. But this is what we like to see. Smart money, the banks, institutions, with enough force, push the market higher, all right? Trying to fill orders quick enough, okay? Because they want the market to continue run to the upside for whatever reason they choose to go up here and grab liquidity before they make a decision, possibly to push lower. whatever their decision is. We're just trading based on what we see them doing. That's what trading is. It's based on probability and trading what you see. Okay. And following price action. Price action and market structure are king. Those two are what's going to either allow you to be profitable or not. I don't know how to stress that enough, because if you just, I know that some people learn quicker than others, and some people are just not going to learn it at all. And trading is not cut out for everybody. And there's a lot of intricate and moving parts that you have to understand, meaning with your eyes to visually see what happened when the market got back to that zone. What did price action look like? Do I have a viable opportunity to take a trade based on what price action looks like? All right, so the market got back to the zone on the higher time frame. This is where I move down to my lower time frame chart. The market pulls back to where smart money pushed higher. Okay, pulls back, and when we see that as an imbalance, basically, or a gap back at the zone, you can just, logically speaking, you have to tell yourself what took place here. Well, they filled orders quick enough and didn't come back and fill the area back down. Okay, quick enough. All right, meaning that they placed orders, but they didn't get filled. Some probably did, some probably didn't, and you can see that here on the charts where the market doesn't immediately come back to an area where they were filling, putting on orders right here. They have to come back. And they have to do what when they get back to the zone? The market correct itself. It has to fill the areas of gaps or imbalances. When it gets there back to the zone, we can look for an opportunity to go long, because they're going to try to go ahead and fill the rest of the orders that they may have back in this area. Just think like that. If they're pushing hard to the upside, that tells you they got a bunch of orders they're trying to fill, and more than likely they didn't fill those orders. So when they get back here and to correct the market, okay, to balance out the market, they're going to more than likely fill the remaining orders, and then you have to think, okay, and then size up the market to see where can I take this market back up to. We'll take a look here. This is a small area, but look, there was from this candle here, the first candle pushed here, the next candle came down, and the third candle, there's an imbalance resting in between those three candles right there. Okay, there's an imbalance resting right there. So you have to think that the market is going to definitely come up there and fill in the imbalance right there, is what I'm trying to say. Now, one thing that happened here too, or didn't happen here, I should say this, is that we didn't break structure back to the downside. Meaning this final high right here, there was no swing below it. Okay, all right, meaning a high, higher low, and higher high that formed, and the market took it out. No, we just pushed up here and came right back to the zone. So when that happens and the market immediately comes back to the zone, we can look immediately over our lower time frame chart, entry chart, to see if we get the rejection to at least take it back so the market can fill in this imbalance back to the upside. It's very simple. So let's go down now to the lower time frame chart. All right, so I'm on my 12 range chart. This is my entry chart. This area right here, where you have this green box, this is that same area right here. Okay, if you don't, I'm just going to show you right quick. Put it on all charts. Now when I go over to my 12 range chart, you're going to see, there it is. This is the 60 range demand zone, okay, off the higher time frame. Now we're in the zone. When the market gets to this zone right here, what I like to see is that where there is basically a break of structure to the upside, a creation of a demand zone created, or formation of, or there's a demand zone that's created after a break of structure. So basically, I'm looking for the market to change direction on the lower time frame, creating a structure break and an area where there's a demand area. Now, where are we gauging to? Where are we going to take the trade to? Again, to fill in the first area of imbalance, resting back up here around 65. Okay, 65 or 66. 665 or 666 area. Is that correct? No, I'm sorry. Where am I at? Right here. Yes, I'm sorry. I'm looking over here. Right here. Back up here to, yes, 65 or 666 area. So let's go back down to the 12 range. Okay, so we're here. I'll mark this area right here. We get a break up to the upside, okay, on the lower time frame. All right, break of structure. You can call it change of character. Breaks above this last lower high right here. Lower high right here. When it breaks above it right here, it pulls back. Small area of demand. You could have waited to take the trade. When the market comes back here, I talk about wicks. When the market hits a zone, the first time it taps into that zone, if it moves away from it with a wick. So this bullish candle you see right here, this is a hammer candle. It came down. When it tapped into the zone, it wicked away from it real quick and closed with the hammer to the upside. I'm going to be aggressive and get in right there. Now, is that an aggressive entry? Yes, it is. The thing I talk about most times is what? The break and close of a candle above. So what you can do is wait for a break and close of a candle above, say this of the last bearish candle right here. Okay, so it pushes up and it pulls back, and then it pushes up here. So it's kind of, you don't get a clear definition or clear look of a break and a close of a candle above. So what you probably want to do is maybe it's when the market does this little sideways movement right here, it pulls back again. At the break and close right here is where you want to get in at 653. Okay, so the market didn't give you a close or a break and close of a candle above this last bearish candle before it tapped into the demand zone right here, and then it pushes up, pulls back, pushes higher. This down candle right here, when you get a break above there at 653, go long. Okay, and we're aiming for, again, 665, 666. You take that trade, you're going to pick yourself up 11, possibly 12 points, and look where it goes. It goes right up to 75, but it goes right up there to the feel of that imbalance right there in that area. Again, beautiful trade setup. We're falling behind smart money, the smart money trading. Okay, the concept of what we look for based on aggressive buying and selling at specific key areas. But we're also got to be mindful, as I said, you have to be mindful of the structure of the market. It pushed down, but then it pushes higher on the higher time frame, breaking structure back to the upside, makes a high, higher low, follow with a breaking structure here. We've got a clear area of demand here. Mark the zone. There's a gap there. High probability zone, untested. Gets there, move down to the lower time frame. Is in an area where the market can go back and fill, at least an area of imbalance? Yes. Right back up here to 665, 66, excuse me, guys. And you move down to the lower time frame. Look for the rejection to take place. The rejection for me is looking for a break. Okay? All right? A change in direction, and then a demand zone, a demand area created. There was demand here. Or you could have waited where it pushed up here and gave you another opportunity. It made a high at the breaking and changing direction here, a high, higher low, higher high. Okay, now I wouldn't take it in this area here because this is kind of, it's not clear to me, but it makes a high, higher low, higher high, boom, demand right here, and it pulls back where? To the higher time frame demand zone. Okay, so, and this is a high probability setup because we have a gap resting back at this zone here in the lower time frame. And you just wait for the break and close of the candle above to go long, all the way back up to 666, 665 area. Simple as that. I don't know how to stress it enough and break it down and simplify it enough. I mean, again, every setup is not going to work. You have to get out the trade if it does not work and it starts to come back against you. So, typically what I like to say is, because people always ask, where should I place my stop loss if I get into a trade setup like that? The back end of a supporting swing. The market broke, it changed direction right here when it broke above here on the lower time frame again. Okay, because that's where we're basing our trade entries off of when we're looking to get into the market for confirmation or looking for the rejection. It breaks this area here, so we get the reverse direction on the lower time frame back to the upside. I'm going to place my stop here at the back end right here at 643 if I'm looking for a pullback to get in at the zone. Now, if I'm looking for a pullback to get in on this movement where it broke high here, a high, higher low, and a higher high, and it gets back to this zone right here, I'm going to go ahead and mark the zone so you can see what I'm talking about. This would be the zone right here. Right here. This would be the zone, the second zone, right here. See how it made a high, higher low, boom, broke to the upside. What is this right here, guys? 1, 2, 3, 4. Aggressive buying. Pulls back. It's untested. It's a high probability zone right here. You get the break and the close of the candle above, you go long. Where are you going to put your stop loss at? Right here at the back, at least I would, at 648.5. I'm not telling you to, but I'm just saying that's where I would. But give it a little bit of room, okay? Give you a few ticks there because they love to come down there because they know traders are going to enter the market right here. But this is another area to get into the trade at because you have the market pulling back to where the higher time frame or higher base chart demand zone, and then you created, there was a creation of a demand zone on the lower time frame. So you got confluence there. All right, look for the rejection, go long, and aim for that higher time frame area of imbalance resting right here at 665. It's as simple as that. Again, there's no. If you can't see that way, then I don't know how to tell you. I've walked through this stuff over and over and over and over. But if you spend time, that's the thing. You have to spend time going back and back testing this stuff and testing it with your own eyes, your own time. And I'm not saying put in 5 hours a week. Guys, I put hundreds, possibly thousands, I'm sure thousands of hours in over the last 13 years or whatever, sitting here practicing this stuff. Okay. And I still don't stop. On a week, even on the weekend, I'm going back reviewing my trades. On a daily basis, I'm going back reviewing my trades. You have to. Okay. If you think you're going to get in this business and it's going to work out overnight, it's not going to. You've got to put in the time. If you think you're just going to be able to pay someone for a strategy or watch someone's videos and then you just pick it up overnight, it's not going to happen that way. Okay? All right, somebody can show you something and it works for them, but it may not work for you because you didn't put in time to practice it and understand it. And then you get frustrated and stressed because you get stopped out and you can't understand it. Well, more than likely you don't understand market structure, for one, and two, you don't know how to read price action. Simply put, but you got to be able to master this stuff if you really want to make it work. I don't care what strategy you use. Market structure, price action is not tied to any particular strategy. Okay, all right. You need to learn that because those are the concepts that all beginner traders need to learn to put them in the pathway of being able to become successful. The next step is devising or learning a strategy that's going to work for you, but you got to master market structure and price action first. Yep, but that's all I have for you guys today. I appreciate everyone tuning in each day, watching the videos, and I mean these videos are for educational, for entertainment purposes, and well, I should say for educational purposes in a sense. I'm not telling anyone to follow behind the way I trade and trade the same or similar way. It works. We have people who are successful trading the way I do over on the Discord. But again, not every trade setup is going to work. You have to understand that. I don't know why people always think that because they waited and saw a setup that unfold and they follow the same step-by-step process and taking a trade that is basically shown that they think it's going to work out every single time. No, you have to get out the trade when it doesn't work out, simply put, and then wait for the next setup. And it's a game of probability here we're playing, okay, when trading. So, but anyways, I appreciate it again that everyone that watches the videos. If you are not a subscriber, I should say, if you're not a subscriber, please take the time to go ahead and click on the sub button. Make sure to turn on all your post notifications, okay? Click on that bell that says all to turn on all your post notifications so you never miss one of the uploads here on the channel. If you're interested in joining our Discord, find the link down in the description portion of the video. Just scroll down. You'll see two links there. You'll see one that says Discord, another one that says Become an Elite Member. That's if you want to become an elite member. It's $6.99 a month. You can simply click on that link or click on the join link on the video page here or over on the YouTube main channel page. But either way, what that is that you receive the trade breakdowns. Those are videos where I break down and go into detail about trades I've taken so that you can grasp an understanding of certain trades I took. So basically, trades you see me take on the video or trades that I post over on the Discord, I go into detail about those trades so that people can get a further understanding and see why the trade worked and the strategy and me giving this discussion of my thought process before the trade, leading up to the trade, just the full nature of, and understanding why I took the trade. But outside of that, if you're interested in doing so, I definitely appreciate you supporting me as a content creator because that's what you're basically doing by becoming an elite member is supporting my efforts and the videos that I'm creating, the content here to help other people because I want to see other people become successful and become profitable. And but whatever you do, educate yourself on and possibly learn from anywhere. Put your own twist on it. All right, spend time back testing it. When I say back testing, I mean you're gonna have to put in the time, lots and lots and lots and lots of hours. Okay, I put years in this stuff. So and I know when to get out when something doesn't work for me. I cut the trade earlier. I'm not going to stay in a trade and allow myself to incur crazy amounts of drawdown. That's what makes a difference also of someone being successful or a trader's being successful or not. Cut the trade early to live to see another trade. Okay? But also, if you found value in today's content, please drop a like on the video by clicking on the thumbs up button. I'll see everyone in the next trading video. I'm about to jump over and start looking at the markets myself and to see if I can identify a couple of trade setups. But anyways, take care. See you in the next one.